This specific and yet insanely simple 1 minute SMC scalping strategy has made me over $100,000 in verified trading profits in 2024 alone. And in today's video, I'm going to be revealing that exact system with you step by step. I'm going to be covering 3 simple and easy to understand steps, starting with the first thing that I do every single day when I first get to the chart to understand exactly what my game plan is for that specific day. Step 2 is identification of smart money manipulation, meaning how to avoid being manipulated, which is the second thing that I look for every single day. And finally, my multi-time frame entry confirmation model that allows me to execute on lower timeframes to get insanely high risk to rewards. And then finally, gathering all of what we've just learned and walking through a step-by-step video of how I incorporate this exact trading plan into my live execution, with showing you a back-tested trade that I took just a couple of days ago. And I'll prove it to you by showing you this is the exact forecast that I give my inner circle members just a couple of hours before it played out. Let's dive into the video. So step number 1 is just simple understanding of how we build our directional bias every single morning. Now, this is a very basic example. So in step 2, I'm going to explain it a little bit in more detail, but let's cover the basics right now. Now, the first thing that I do before I do anything is I understand what direction that market is trending in, because I need to understand that so that I can make sure that I'm trading in alignment with the higher time frame understanding. So what we're going to do to understand this is explain it theoretical first, and then I'll explain it later on the charts when we get into our trade breakdown. Obviously, at any one given time, we are creating a series of high, low, lower high, lower low, right? So break of structure down here. So we're obviously bearish at this moment in time. Now, if we were in this scenario in real life, this was the market structure, high, low, and I was coming into the market and this is the picture that I seen, I would be expecting what? Yes, lower prices. I would be expecting price to continue trading lower. Then after we essentially get that, then you would likely be expecting some kind of pullback before some kind of continuation. Now, this would again be another break of structure, right? Just a continuation of trend. It's actually very, very simple. But what oftentimes happens, of course, is eventually a trend becomes exhausted and we have a reversal, a shift in the other direction. So when price is being put in high, low, lower high, lower low, lower high, lower low, lower high, lower low, at some point in time, it will probably come back up and give you a higher high. This is the first sign that the trend has begun to shift. And this is what we call a change of character, right? It's essentially the shift from bullish to bearish or from bearish to bullish. In the event that you get this change of character right here, well, then you would literally just be expecting that price has some kind of pullback, some kind of continuation, some kind of pullback, some kind of continuation. So what we need to understand is where are we in the current market pricing to understand where price is likely to head to next. For example, if we know that we're taking out old highs and we're respecting old lows, then we're bullish. So we know that we want to look to long for that specific day, because your job as a scalper is simply just to understand what is this exact session that I'm currently trading going to do. For me, my sessions are around 3 to 4 hours. I trade 2 different sessions, London and New York, and I only care about what's going to happen in that short time frame. So the 15-minute time frame, we want to identify our highs and lows, understand what direction we're currently trading in, and we want to look at something that we can trade in alignment with that direction. Now, let's go into a little bit more of a realistic guide as to what this would look like. This is the reality of market structure. And now I know you're looking at that and you may well be confused, but it's actually a very simple thing to understand. And I'm going to show you where so many traders go wrong, and honestly, probably yourself also. So the first thing I do, if I was to come to the market, and this is exactly how the market looks, I would understand my market structure. So what would I do? I would mark out my high, I would mark out my low, I would understand, okay, we came back up, we respected this high, we continued lower, we broke this low right there, so that's a break of structure. So I understand that I'm bearish, so that when price comes back up in here and then begins to reverse, I already know before it has even happened, I already know that we are going to target this low down here. So that becomes a weak low, that becomes my primary target, right? So that's a weak low, that was the high, this is the low, and then this becomes the new high. Now here's the mistake that so many traders make, right? Because what they do is when they see this old high get broken up in here, they for some reason think that the market structure has shifted, and now they start to look for long position, but they haven't built an understanding principle of how we map out highs and lows. So here is my guiding principle for you to take away. Now, every time there is a high and a low, you need to mark out the highest point of that structural range and the lowest point of that structural range. Anything inside is not structure, it is simply internal price action. When you have lows and you have highs like this, these aren't structural levels, these are internal levels. So if one of these levels gets broken, which they always do, by the way, because liquidity sits above that level, we'll get into that later. But if one of these highs get broken, many people think that now it's time to look for longs, but actually we are continuing in our bearish structure. You have to ask yourself, what was the high that broke the previous low? This is the high. Therefore, price is in control from this level. Until this level gets broken, we are bearish. So don't get trapped on these internal structural levels. From there, we go on to put in a new lower low. So guess what? Where is our high? Our high is here, our low is here. We don't care about this price action here. This is internal. And then what happens? Well, we were bearish, right? So every time that price puts in a new low, we want to do what? We want to sell price in this price leg. Again, we put in a new low. On the pullback, we want to be selling this price and targeting this price. And then, as always, at some point in time, you will have some kind of structural shift, which is our change of character. So then guess what? We have a lower low and a higher high. This is likely now that price is reversing. So we want to be looking for long positions now, aligned with the higher time frame. And then you can see that we break structure, we come back, all internal, not important. We bottom out here, and then we take out the swing high up here. So where would you go from here if this was the picture you had now? If I was coming into the market and this is the exact price action that I had, well, I would be looking at, okay, this is my high, this is my low. Okay, we've had a break of structure to the upside. Okay, cool. So we're bullish. Perfect. Now I need to identify an area of interest that I can look at longing from. So what I would do is I would take my fib and I would put it from the low to the high like this, right? And that will give me structural levels. We have the 50% of this entire price leg, 61.8%, 78.6%, and then the bottom. So I would wait for my bias for that day. What I would say to myself and my students is, guys, we are waiting for some kind of pullback into these areas of price, waiting for a shift in price delivery, and then we're going to trade higher like this. And that is essentially how I would get involved in the market. So let's go dive into step number 2, understanding manipulation. So my step 2, how to frame and understand a manipulation. Essentially, what is a manipulation? Let's just cover that real quick. A manipulation is essentially when, banks, financial institutions, smart money, as we call them, manipulate price into obvious levels of liquidity. Okay, what's an obvious level of liquidity? An obvious level of liquidity is an area where large groups of people are likely to place their stop losses. So think about simple trading strategies. Equal highs, equal lows, trend lines, support and resistance. All of these areas have one thing in common. They attract liquidity. Because people look at the market and they think that something is going to happen because of that. I'm here to tell you that that's not how the market moves. That is not a causality of price. So what happens? A lot of the times when smart money wants to move the market, they first run price into these liquid levels to initiate those orders so that they can take the opposite side of the order and get filled in their positions at better prices. Very simple concept to understand, very, very effective. So the second thing that I do is I'm always looking, okay, I know right now that we're bearish, right? I would come into the market, I would say, okay, we have a swing high, swing low, swing high, swing low. Cool, we're very obviously bearish. So my bias for today is lower prices. My 3-hour window, I'm expecting lower prices for this day's worth of price action. How can I get involved? Well, before I try to get involved, I identify where is the obvious levels of liquidity. So in this example right here, you can see we have equal highs up in this level. Well, what does that represent? It represents a bunch of different things. Number one, it represents stop losses, right? There are going to be a lot of stop losses in that level. Why? Because people see these equal highs or as an area of resistance that price is for some reason respecting. So many people sell in and around this level. And where do they put their stop losses? They put their stop losses above these old highs. So if they are selling in this level and their stop losses are in this level, then essentially when price comes into this level, it will execute liquidity on the opposite side of the market. Now, why is that important for smart money? Because smart money is then able to use that liquidity to fuel their positions without moving the markets. You see, a market is very simple to understand. You have buyers and you have sellers. For every buy order, there has to be an equal amount of sell orders. If one person wants to sell $500 of something, there has to be a buyer or multiple buyers willing to buy the full amount or small portions of that amount at the same price for there to be a transaction at that specific price. Very simple to understand. So what happens then if smart money need to sell $100 million of Euro USD at one specific price level? Their goal is to get it as close to that price as they can. Now, the problem is they need opposite side liquidity for the same amount at the same price. So they engineer this type of liquidity so that when they come and they put price into this level, guess what? All of that liquidity at that level, they've built herds and herds of people all put in a small amount equals a large amount. They're able to use that liquidity to pair their orders with and get the fill that they wanted at that specific level. That is smart money manipulation. So I need to understand where is the obvious manipulation for smart money, because they will drive price into that area before moving in the other direction. You have to understand that market structure is indicative of where smart money wants to trade to, because that's what makes the market structure. You see, smart money may be very good and very powerful, but one thing they can't do is hide what they want to do. If you see price obviously trending in a bearish market, then it is obvious that there is some entity that wants to take price lower. Obviously, that's why price is going lower. There are more sellers than there are buyers. And in many cases, that is just very large institutions. So if price is bearish, that simply means that smart money are expecting lower prices and they are pushing lower prices. If they want to initiate a gain in that same price leg, creating opposing side liquidity and then running that liquidity before the real move is what they will do time and time and time again. So the second thing I do after understanding what direction I'm trading in is I find obvious liquidity levels that I can wait for price to tap into before waiting for step number 3. Because when price taps into here and I get step number 3, that is when I execute and that is when I get out. Very, very simple and easy to understand model. I'm always trading with the trend. I need to understand what the trend is. I'm always looking for smart money manipulation so I can wait for that to happen and then get involved in the real move. Because how many times have you got into a position and then just before it aggressively went in your favor, you were stopped out first? How many times has that happened? If it happens over and over and over again, it no longer becomes a coincidence, it becomes a pattern. And this is that pattern that I am referring to. So let's dive into step number 3, which is how to turn this into a profitable system. So step 3, and this is the holy grail. I can't even believe I'm sharing this over and over and over again with you guys. So now what are we going to wait for? Well, in this scenario, I've used a bullish example. So you can see that we have a swing low, a swing high, a swing low, and a swing high. So we are bullish. So when I come into the market, if this is where I'm coming into the market, I am only looking for buyers, right, for my scalping system. I'm only looking for buyers. Step 2, I need to identify liquidity on the opposite side. So if I see this right here, right, liquidity in this level, well, guess what every man and their dog is thinking? Everyone's thinking, oh, well, especially in important times like London, where all the retail traders come in, New York, where all the retail traders come in. Oh, well, look, price is trending bullish. Oh, look, London opens and we have a bullish move. Oh, look, I should buy. Price is going to go higher. And yeah, they are right. But everybody's thinking the same thing. Pretty much most people are looking to go long in this specific session because we've had bullish price action. But it's about when you get in, not what direction the market's going to go, which is why so many times you've been right on what direction you want to go, but you've been wrong on how to get in. Probably because you missed the manipulation model. So if I come in and I see this, I am waiting for a manipulation of these lows, right? Like this. Now, this, what we are looking at right now, is the 15-minute time frame. That is the time frame that I use. So on the 15-minute, our swing low is down here. our swing high is up here. Liquidity is in this level right here. So we're bullish, awesome. But at the moment, we're seeing some kind of bearish price action, right? When price manipulates into this liquidity, price is obviously trading lower. Well, guess what I do? Once we have this manipulation, I go down to a 1 minute time frame to get a zoomed in version of what's actually unfolding right now in price action. And so guess what? When I zoom in, so you see this bearish action right here. Well, guess what? What do you think that I see when I zoom in on the 1 minute time frame? I see very, very bearish price delivery on the 1 minute time frame. So once I get that manipulation and I go down to the lower time frame, I will inevitably be bearish. And what do I wait for on the lower time frame? I will wait for price to go from putting in these, bearish moves like these, and then I will wait for a bullish move like this on the 1 minute time frame. And when I get that bullish move, that is my confirmation. And that is how I get high risk to reward moves. Because what I could do is I could just put an order on at the liquidity level on the 15 minute, right? Something like this, for example. I could just put a buy order on like this, for example, and I could put my stop loss at the low, and then I could put my take profit at the high, right? I could do that, but that only gives me a 2.89 risk to reward ratio. And if I want high risk to reward ratios and like sniper entries as a scalper, I need to zoom in and understand what's happening on the 1 minute time frame. And that is where the 1 minute comes in. Once I see that manipulation, I go down to the 1 minute time frame. I wait. It's bearish, it's bearish, it's bearish. And then if price is going to continue trading higher, the 1 minute will shift bullish way before you see the aggressive move on the 15 minute. So it's like an insight into what's about to unfold, and you're getting there early. That's exactly what it is. You wait for this confirmation, and then what you do is you trade on the 1 minute time frame. And then you get a sniper entry, right? You can trade something like this, and then you can take your profit at the highs like this. And now all of a sudden you have 5x, almost 5 times the risk to reward that you could have had by staying on the 15-minute time frame, just by zooming in, waiting patiently for confirmation that the order flow has shifted. And then you are set to go, and that's when you execute on the trade. And now I'm going to show you a live example of the exact trade that I took using everything that I've just shown you. Now this, what you're seeing on screen right now, is the exact trade that I took. And to prove it to you and to show you that we forecasted it before it even happened, watch this very short clip of me showing the members and telling the members hours before this happened exactly what I'm looking for today. So yeah, if I'm going to trade euro dollar, looking at longs first and foremost, and I would want to see the aggressive push out of here heading into London, some kind of pullback into here, and then a continuation up to the previous swing high for a M15 continuation of trend, which aligns with a higher time frame potential pullback. So more than happy to play that. Now let's dive into why I said what I said and why I did what I did, following the principles I've just shared with you right now. Okay, so we're going to bring price back just as London session was opening, and as I was on the live call with my inner circle members, giving them exactly what I'm looking for this specific day. So step number one, as you already know, is to identify the market structure. Now, you can very clearly see that we were very aggressively bearish, right? At one point in time, euro dollar's been trading aggressively bearish. We had a low, we pulled back, we had a low, but this is actually the same low because it's only a wick. So this was our swing low, this was our swing high, this became our swing low, this became our swing high. Now, if you're wondering why this low and why this high, that's because we have a specific rule that determines what's a high and what's a low, and it's a rule that we follow every single time without failure, so we always understand, are we bullish or are we bearish? So this is the low, this is the high, and then this right in here is our change of character, because we were bearish and now we've shifted to potentially being bullish after we get this, right? Higher high. And then what happens? We pull back and then we go next day, higher high again. So now we've had a break of structure and now we are definitely bullish. So break of structure, we are bullish. So I'm coming in now to London session, and what you're seeing right now is the picture that I have. So I know then, 15-minute time frame, I know that this is my swing low, and I know that this right here up in this level is my swing high. Awesome. We've already had a pullback, so we're already in this level. We've already run into the liquidity, right? The liquidity in this sense is this kind of trend line that was building, that again, you can see eventually got obliterated. So we had a run on liquidity. Okay, and now we're putting in this structure, and now we're getting ready to go. So for me, what I wanted to see was a bullish momentum heading into London session. Now, this was the first sign of bullish momentum, but unfortunately, that wasn't our move because it's a wick. I need to see it break that high. So we wait patiently, we wait patiently. That's our first sign that we could be getting ready to go bullish, and then boom, aggressive move. Now, guess what? Every man and their dog who is trading London session right now, watching Eurodollar, is getting ready to buy because it's trading so aggressively. We are overall bullish. Everyone's getting ready to buy. I already know that. And I already know that they are going to want to be getting in either, after the break of a high or a break of a high in here, and they're getting in here and their stop losses are going below these lows, or they're waiting for, a break and then a retest, and then they're putting their stop losses again in these lows in here. And there are a bunch of people that are looking at this overall level in here as a trend line, right? Touches, aggressive move out. And so maybe they've already longed in this level and they put their stop losses, inside the trend line, or maybe they put their stop losses, in these regions in here, whatever it is. All I know is that there are lots of buyers, and I know that this area is full of stop losses. And I know that this area is full of orders. So simply put, I am waiting for a manipulation. And guess what? Even SMC traders can be stop losses, can be liquidity when they are inexperienced and don't know what they're doing because they lack context. And so what they do is they try to just trade every bullish move with every bullish order block and every bullish fair value gap. But that's not how the market works. Primary principle, understand liquidity. So it's very simple. As we have in this move, I am absolutely want to go bullish. I need to see confirmation. So I need to see a liquidation of something in here. If price can run into these levels for me, that's perfect. Now my London session has finished, so there's even more liquidity in here because when London opens and buyers inside of London are getting ready to load up on their positions, they're putting their stop losses at these London low levels. So heading into my New York session, we get what? A run of all of this liquidity. Now at this point, and also I will say on a higher time frame, it's also an order block, but at this point, the run into liquidity tells me that we're bullish. Step one, we've just identified smart money manipulation and we've entered into that level, but I don't want to just buy in this level, right? It's a very random area to buy. If I was to buy, I would have to buy, from here. I would have to put my stop loss at the low because I don't really know if it's going to trade lower or not. And my take profit would be up here. It'd be a 1 to 2 risk reward, which is fine for some people. But for me, I want to wait for a lower time frame confirmation. And let me show you why. So if we go now to the 1 minute time frame and look at this same price action, what are you going to see? Well, you're going to see very bearish delivery, right? It's very obvious that price is bearish. We're putting in all these lows, these highs, these lows, these highs, these lows. We're bearish, right? So the current swing low on the 1 minute is here. The current swing high is here. The current swing low is here. Now, we don't know when price is going to reverse. Price could come into more of this liquidity. It could even take Asia low, which is also a pocket of liquidity, right? We don't know when price is going to reverse. We don't even know if price is going to reverse. It's just probability. But to manage that probability, we need to wait for confirmation. So I come onto the 1 minute time frame. I know what's going on with price, and I simply just wait and wait and wait until we get some kind of confirmation, right? In this scenario, the confirmation would be a shift of this high, because again, if price was going to continue trading lower, it would not be breaking structural highs. We're already higher time frame bullish, so we're expecting a high to get run. We're expecting bullish. It's already our bias. We've had a run into liquidity, so now we know that they could execute, and now we're just waiting for confirmation, right? We're not waiting for a random break of structure. There's context. And then guess what? We break that level. So that becomes a change of character, and that becomes my entry confirmation that we have just shifted bullish on the 1 minute time frame, which means we can execute on my trade. Problem is New York hasn't opened yet, and I have rules and I'm very strict to my rules, but there are 3 minutes before New York session opens. So I can't put a trade on until those 3 minutes play by. So it becomes 1, 2, 3. Cool. Now the yellow box opens. That is, 8 p.m. for me. New York has just officially opened. Now I can execute on my trade. So I always look for, really, where did we break structure? Okay, we broke structure here, and then we're looking for the manipulation before the aggressive move. It's like a V-shaped recovery, right? We're looking for the area which essentially gives us a break of structure and reversal. We want to look for the sells before the buys, because the sells followed by the buys, a lot of the times the sells are initiated by smart money because they want to run into lows. So we can play off the back of that levels protected. Other times what I do is I go to the 5-minute time frame just to look and get clarity for a specific order block. The order block for me is always kind of the final sell before the buy. So this sell here with the long wick that manipulates old lows and then the aggressive bullish momentum, that typically for me is a bullish order block. Sometimes it's a little bit different, but most of the time it's a sell to buy range. And then the stop loss would be 5 pips. I add a little bit of extra room, 5.5 pips, just for, you know, any buffer or anything like that, anything with your broker or anything like that. And then I set my targets. So I always have a fixed 5 risk to reward target for my first one. That's because even if I'm wrong, even if price doesn't continue bullish, I can still most likely take profits. And then my second target is always aligned with my higher time frame structure level. If you remember, if you zoom out on the 1-minute time frame, we are bullish, right? On the 15-minute time frame, we have lows to highs to lows to highs, and now we've just pulled back, and guess what? We're getting ready to go new highs. So I just play my understanding of structure, and it's intraday, it's within one session, typically speaking. And so that becomes my first target. My second target becomes the swing high up in this level. And then you just wait. It's just a waiting game. You wait to get tagged in, you take a stop loss, or you take a win, literally. No system ever has a 100% win rate, obviously. When I get a break of structure, most times I will go to break even, and then I will wait for price to trade me in my right direction. At this point, I take off some of my position, because we've hit 5 risk to reward. I lock in some profits. I wait for the rest of the position to get run. The rest of the position runs up into the swing highs up in this level. And then it's just a waiting game, waiting for price to either hit your take profit or hit you at a break even. And in this case, we hit our take profit level. Don't forget to like, comment down below what you want to see next, and make sure you are subscribed to the channel so you don't miss any uploads.